Hello everyone, my name is Rubina. Today I'm going to talk about the different types of accounting concept and the techniques used while working on this assessment. This report aims to analyze the taxation liability of the Harvey Norman, one of the leading company in Australia, which is also listed in ASX. It deals in the electronics, communication, padding, and furniture with more than 10,000 employee. Company operates in more than 190 countries. This presentation aims to highlight the income tax related issues which are faced by Harvey Norman. The taxation structure of the company has been analyzed in this assessment, while as the temporary and the permanent difference in the case of the Harvey Norman has been identified. So I'll be also talking about the accounting concept. Under accounting concept, I'll be talking about the accounting profit, taxable profit, temporary difference, deferred tax asset, and the deferred tax liability. So let's begin with the accounting profit. Accounting profit is the amount of the money left over after deducting the explicit cost of running the business. Explicit costs are merely the specific amount that the company pays for those costs in that the period. For example, wages. Accounting profit is also known as net income. In the net income is reported on a quarterly and annual basis and is used to measure the financial performance of the company. The taxable profit is also known as taxable income. The taxable income is calculated as the difference between an company accessible income and the deduction. Taxable profit may differ from the reported earning and may be higher or lower. Company financial report often distinguish between the profit before tax and profit after tax. The temporary difference, this can be revised in the future. The difference between the asset carrying amount and the liabilities which are shown in balance sheet is treated as a temporary difference. This does not create the issue in a financial statement. It can be adjusted by making necessary adjustment. The deferred tax asset, it is the asset for the company. The difference between the income tax payable and accrual income tax, these are reflected in the balance sheet of the company. The main motive of reflecting deferred tax asset is to reduce the taxation liability of the company. So let's talk about the deferred tax liability. It refers to the variation of the it refers to the variation between the accrual income tax and the income tax payable. It has to be paid in the coming years for recording the deferred tax liability, and and deferred tax expenses account has to be debited and taxable account has to be credited. The recognition of deferred tax and the deferred tax liabilities. Although the company has a option to adjust the advance tax in the future years, as the excess payment which is made in the form of the tax is considered as the assets for the company. On the other hand, the tax amount which is not yet paid is treated as a deferred tax liability. By analyzing the financial statement of the Harvey Norman, it is observed that the deferred tax liability was 12,335 in 2018, which has increased to 37,236 in 2019. Several factors are responsible for positive shift in deferred tax liability of the company. The company is the company is recording this as a deferred tax expenses. Deferred tax liabilities are shown in the liabilities side of the balance sheet. So the tax, let's talk about the tax expansion of the Harvey Norman. There is a positive shift in the profit of the company in the current year in comparison to the previous year. With the increase in profit, tax expansion of the entity of this sorry with the increase in the profit, tax expansion of Harvey Norman, the entity has also increased. The tax expansion of the entity for the year 2018 is 150,000, which has shifted positively in 2019. In 2019, the entity has paid the tax of 165 165,500. The financial cost is excluded in this amount, but it covers all types of the incremental costs. These are recorded after making the final adjustment. Final adjustment tax expansion should match with the rate which are set by taxation authority. Company tax and accounting income. Taxable profit of entity is calculated as 51.65 million for 2018 and 70.30 million for 2019, which shows that there is a variation between tax on accounting between the tax on account on the accounting income and the actual tax expenses. This difference has arisen because of a various type of adjustment which were made in accounting profit. Along with this, there can be another reason for creating the variation in tax expansion, which is recorded in the book and which are actually paid. For example, if there are a certain adjustment of the previous years but these are not taken into the consideration in the previous year, then this will increase the taxation liability of the company in the current year. The reason for recording the deferred tax liabilities is that the liability which is created in respect of deferred tax is treated as the temporary deductible difference. These liabilities are carried forward in the next financial year. The deferred tax expenses are recorded for the lowering down the entity tax expenses. Recording of income tax payable. In the year 2018, tax liability of the company was 12,000, which has changed to 15,608 in 2019. These liabilities are shown under the long-term liabilities. The difference in the amount of income tax expense and the income tax paid. There might be the possibility that actual income tax paid might be different from taxation liability. In such case, a reason for variation has been analyzed, and the temporary difference and the permanent difference. The temporary difference is defined as the difference between the taxable income, which I have already talked in the previous slides, and in the pre-tax book income. These difference are reflected through difference are reflected for both accounting for the tax purpose and the financial accounting. These difference are recognized at the time in the accounts book. The treatment of taxation liability from entity of a financial statement. The financial statement are formulated at the end of the financial year for reflecting the financial position of the company. Amount of the taxable profit is computed from the entity's financial statement. Company is liable to pay the tax on its taxable profit. In case of company, corporate tax rate is applicable. Tax appears in all the three financial statements. Most interesting part for me is to analyze the deferred tax liabilities of the company, which are highlighted in the liability side of the balance sheet under the long-term liabilities. I gained the understanding of how deferred tax liabilities are treated in financial statement. Long duration liabilities are to be paid after the 12th month. The tax treatment was one of the most challenging part for me, as a various provision has to be considered. So to conclude this presentation, I have tried to cover the treatment of the tax in Harvey Norman, which is also the Australian-based ASX company. The tax expansion of the company was calculated from its financial statement. Various provisions related to the treatment of income tax were discussed. And has been discussed in the assessment as well. The accounting treatment for different types of profit, that is taxable profit, accounting profit, and deferred tax, has been analyzed. The asset and the liabilities which are reflected in the financial statement of Harvey Norman was also analyzed with the suitable example, and in the assessment, and also the financial statement of entity has been analyzed in this report. Thanks for watching. Thank you very much.